Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at GameStop.
If you find our talks useful, please consider subscribe, like, and comment underneath. It really helps us get this information out to more investors like you.
So looking at the calendar, it is Friday, February 6th, 2026. And honestly, I think the most important thing we can do right now is just take a deep breath and hit the reset button on everything we think we know about this company.
The reset button. You mean we need to forget the memes? Because let's be honest, for the last 5 years, whenever someone says GameStop, the first thing I think of is a Reddit forum.
A headband, a squeeze, yeah.
Exactly.
And that is the biggest trap an investor can fall into right now. If you're still looking at this stock with that 2021 energy, you're looking at a ghost.
Okay.
The company we're breaking down today is fundamentally mutated. It's not a struggling mall retailer anymore. We're looking at a completely different animal. We're calling this the strategic war chest turnaround.
Strategic war chest. I like it. Sounds aggressive. But turnaround is a heavy word. It implies they were, heading off a cliff. So what's the mission today?
The mission is to answer one single question. Is this company still a dying brick-and-mortar store? Or has it successfully changed into a diversified holding company? Because the raw numbers suggest a massive evolution has already happened.
Okay, let's get into those raw numbers. But we have to be real. Retail is a brutal space. I've seen the headlines. Top-line revenue is down. How do we square that circle?
You're right, and we have to be honest about that. The top-line number looks rough at first glance. In the third quarter, net revenue came in at $821 million.
Just down.
It's down 4.5% year over year.
Almost 5%. I mean, usually Wall Street just punishes that. The algorithm sells, stock tanks, end of story.
And usually that's the correct reaction. But here, you have to look at what isn't selling. This is where the nuance is. Hardware sales, the consoles, controllers, all the big stuff.
Yeah.
That dropped 12%.
Okay.
Software sales, the actual game discs, dropped 27%.
Which, to be fair, shouldn't surprise anyone. The death of the disc has been a thing for a decade now. I can't remember the last time I bought a physical game.
Right. Everything's a download.
So if their core business is down almost 30%, that sounds like the bear case, not the bull case. It sounds like they're bleeding out.
It would be if they were still trying to be Blockbuster Video.
Yeah.
But they're not. And this is the pivot. While those old revenue streams are drying up, they've gone hard into a different category, collectibles.
And that's up.
That segment is up 27%.
Okay, let's drill down on collectibles. What are we talking about here? Funko Pops and T-shirts?
We are. We're talking trading cards, limited edition statues, geek culture, merchandise. It's the stuff you can't download.
Right. You can't download a Master Sword replica for your shelf.
Exactly. Or a rare Pokemon card.
So they're just swapping video games for toys.
In a way, yes. But financially, that is a brilliant trade. Think about the margins. Selling a new PlayStation gives the retailer almost no profit. The margins are razor thin. But a plush toy, a pack of trading cards, the margins are way, way higher.
So they're shrinking their revenue to grow their profit. Smaller, but richer.
Precisely. It's efficiency over volume. And the proof is on the bottom line. This is the stat that really stops you in your tracks. Go back to fiscal 2021. The company had a net loss of $381.3 million.
They were burning over $1 million a day. That's a sinking ship.
Now, fast forward to the most recent fiscal year, they hit a net income of $421.8 million.
That's an $800 million swing.
It's massive. Usually a retailer cuts costs and they scrape out a small profit. They don't swing nearly $1 billion into the green.
That is a complete reversal.
And it shows up in the earnings per share, the EPS. Full year 2024 EPS was $0.33. Compare that to just 2 cents in 2023. That's a 1,550% increase.
1,550%. You just don't see four-digit growth in a retail metric.
Almost never. And the trailing 12-month EPS is now sitting at 85 cents. Because of that collectibles shift, their gross margins are holding steady around 30.8%. Analysts are actually projecting EBITDA growth of over 18%.
Okay, and just for everyone listening, EBITDA is earnings before interest, taxes, depreciation, and amortization. Basically, it's a raw look at their operating cash flow.
Correct. It's a measure of pure operational health. And theirs is surprisingly robust. But even with all that, the retail business isn't the real story here.
Right. The turnaround is nice, it keeps the lights on, but it's not the main event. The main event is the bank account.
The war chest.
I was looking at the balance sheet, and I honestly thought I was looking at the wrong company.
It is shocking. GameStop is currently sitting on approximately $9 billion in cash.
$9 billion.
To put that in perspective, that is a staggering amount of capital. To use a financial metric, their current ratio is 10.4.
And a current ratio of 2.0 is usually considered safe, so they're at 10.4.
It's almost comical. They have 10 times the liquid assets they need to cover their short-term bills. And their leverage ratio is only 2, so very little debt. They are a fortress made of money.
So is that their moat then? Usually a moat is like Apple's ecosystem or something. Is their moat just cash?
In this environment,
Yeah.
yes. High interest rates punish companies with debt. GameStop has no debt and a pile of cash that's probably earning interest.
Yeah.
They are effectively bankruptcy-proof.
So the big question is, what are they going to do with $9 billion?
That's the question keeping Wall Street up at night. You don't just keep that under the mattress.
Well, there was that interesting note in the filings about their cash strategy. It mentioned Bitcoin.
It did, and you have to be careful there, but it indicates they're holding a portion of that treasury in Bitcoin, likely as an inflation hedge or something with high upside.
It signals a certain risk appetite, right? This isn't a board just buying T-bills.
It signaled they're thinking like asset allocators, not shopkeepers.
Yeah.
And that leads to the biggest speculation. M&A, mergers and acquisitions.
The theory is they're going to buy another company.
It's more than a theory. It's practically baked into the CEO's compensation package. Ryan Cohen's.
How so?
His long-term stock awards only vest if he hits a cumulative EBITDA target of $2 billion.
$2 billion. Okay, but they just swung to a profit of around $420 million. You don't get to $2 billion in EBITDA by just selling more collectibles. The math doesn't add up.
Exactly. The math doesn't work with organic growth alone. You get there by acquiring other profitable businesses and adding their earnings to yours.
So it forces him to go shopping. It aligns his personal wealth with building a conglomerate.
He doesn't get paid for the status quo. It basically turns them into a SPAC that already has a profitable business attached.
So as an investor, I'm not really betting on video games anymore. I'm betting on Ryan Cohen's ability to spend that $9 billion wisely.
That is the core investment thesis. You're betting on the capital allocation skills of management.
Speaking of betting, let's talk about who's placing chips on the table. Are the insiders buying?
Heavily. We're seeing cluster buying, where multiple insiders purchase stock around the same time. Lawrence Cheng bought, but the big one is Ryan Cohen. He bought another 1 million shares.
1 million shares, and that's with his own money.
His own money. Not stock-based compensation. He wrote a check. That's a massive vote of confidence.
But he's not the only big name. There's a returning character in this story.
Michael Burry.
The big short guy.
He's taken a significant position in GameStop. Again.
Again is the key word. He was one of the very first people to spot this back in 2019, right? Before the meme thing.
He was. He saw the deep value. You got out during the mania, and now, in 2026, he's back in.
That's huge for the market. Burry isn't a help investor. He's a grumpy value investor.
He looks for deep discrepancies between price and value. So if he's buying, it signals to the institutional world that this is now a legitimate value play, not just a meme.
So we have the cash, the profit, the famous investors. What is the stock actually doing? Let's talk technicals.
The price action confirms this shift. Recently, the stock climbed over 8% to around $25.85, purely on acquisition rumors. Right now, it's consolidating in the $24.52 to $24.66 range.
Consolidating is good. It's catching its breath.
Exactly. We're watching two key zones. The support, the floor, is firmly between $22.74 and $22.81.
So around $22 is the safety net.
For now. The resistance, the ceiling we need break, is between $24.70 and $25.
It's that $25 psychological level.
If it breaks $25 with high volume, the model suggests volatility favors the upside, and the volume is there from both retail and this new institutional interest.
It sounds like a coiled spring.
Oh.
But I have to play the skeptic here. What's the catch? What's the bear case?
Oh, there's absolutely a bear case, and we have to be rigorous about it. The core problem is still there. The legacy business is shrinking.
We go back to that 27% drop in software sales.
Right. If the collectibles boom turns out to be a fad, GameStop is left with a video game business that's melting like an ice cube.
And you can't build a future on that.
That's the argument. There are still analysts with a reduced rating and a price target of $13.50.
$13.50? Wow, that's almost half of where it's trading now.
They argue the valuation is disconnected from the operational reality. They think the market is overvaluing the cash pile.
And there's execution risk. What if Cohen buys a dud? Or buys nothing at all?
That's the danger. The market is pricing in a good move. If they make a bad move or that Bitcoin strategy backfires, the stock will get punished.
But that 1350 target seems pretty aggressive given they have $9 billion in cash.
I agree. The cash acts as a floor. It's very hard for a company to trade below the value of its cash on hand. I'd argue the risks are pretty much priced in at the $24 level.
It's a lopsided bet. Limited downside because of the cash, uncapped upside if the acquisition works.
Exactly. It's asymmetric.
Okay, so what are we watching on the catalyst calendar?
The immediate watch is the Q4 2025 earnings report. We need to see that profitability trend continue and that EBITDA ramp towards the $2 billion target.
And we're watching for the trigger.
The announcement. Cohen has been described as heads down. When a loud CEO goes quiet and insiders buy stock, it usually means the deal is close.
And the macro environment, does it help or hurt?
It actually helps. If rates get cut, money flows into consumer stocks. If rates stay high, cash is king, and they can buy distressed assets for pennies on the dollar.
So they're positioned well for a boom or a bust.
They've hedged their bets perfectly.
All right, let's wrap this up. On a scale of 1 to 10, where do you land on GameStop for 2026?
I'm giving this a bullish score of 8 out of 10.
An 8? That's high confidence.
It is. But look at the elevator pitch. This is a transformational acquisition play. You're buying a profitable company with a $9 billion war chest, with insiders and Michael Burry buying alongside you.
It's a rare combination. Usually you get value or growth or cash, not all three.
Right. The time horizon is key, though. This is a multi-year hold, but the next 3 to 6 months are critical for seeing the plan unfold.
But knowing the stock, there will probably be some swing trade opportunities.
Always. Volatility is part of its DNA.
It really feels like the company has grown up. It's not just a retailer anymore. It's a holding company in the making.
And with $9 billion backing it, the ceiling is much, much higher.
Well, there you have it. A war chest, a plan, and the people to execute it. It's going to be fascinating to watch.
Absolutely.
Thank you all for joining us. If you enjoyed this breakdown, make sure to check out our next episode, where we'll be looking at more wealth-building contexts.
Thanks for listening.
See you next time.